traders, welcome out to your currency midweek for October 12th. Corey here with you. As always, let's start with a quick reminder to make sure that you follow your trading plan. So as we look at this week, it's kind of interesting. I think the lead up is to the CPI report that comes out tomorrow morning. Regardless of what market you're trading, be it stocks or FX or crypto or anything else, I think the CPI data out tomorrow is going to be a market mover, and it has potential to fuel the next leg of whichever direction we're going to go. So stocks are in a bear market. We've kind of talked about that it's been in this inverse cup and handle. We traded in that sort of pattern, but I have to admit, I thought there would be a little bit more bounce to it. It almost touched our target. We said 38.50, and I think it stopped at 38.10 or something like that. But what was weird about it was a 2-day rally. It literally went up 5 or 6% in 2 days and then just violently came back down. And so you have this sort of inverse cup and handle, but it didn't last long. It was just so quick. If you blinked, you missed it, right? Because it was a 2-day rally, 3-day rally, I guess, because we did rally for 2 days, and then it made a little bit higher point there on the third day, and then started to roll over. We'll look at the S&P chart. It basically gave back that 5 to 6% rally in the past week. We're back at or even below the lows. So the inverse cup and handle, that bearish price pattern, is in play for the S&P. But interestingly enough, we have some divergences. We have some things happening. So it's just kind of a confusing picture in my mind a little bit here. US dollar has reached a bit of an exhaustion, and again, it reversed hard. We talked about the exhaustion last week, but now it's kind of bounced back, and so it's probably in more of a symmetrical triangle. It's probably what's going to materialize is a little period of lower highs, higher lows, consolidating. Those are usually kind of a resting pattern, calm before the next storm, and the dollar should take a break. I mean, it just made a huge run to the upside for a while there, so it's due for a little resting type of price action, sideways type of move, that sort of thing. Let me make sure. Aaron is having some sound trouble. Can everyone else just give me a sound check? Let's make sure that your sound is working here. Okay. So everybody else, it sounds like it's good. Let me just send him a quick note here. So Bank of England, so they had initiated a bond buying program. Now they've halted that bond buying program. Now remember, they said, hey, we're coming in with a bond buying program. Many people hoped that that would evolve into a process of them buying and buying and buying. They were just trying to calm the markets temporarily. And so you have a weird circumstance there in the UK. Remember that when you're buying a bond, another word for a bond is fixed income, right? And the reason they say it's fixed income is because a bond is issued with a promise to pay X amount of income, of interest, right? So bonds are usually denominated in either $1,000 or $2,000 size, and they'll have a coupon attached to it. They say, okay, we'll pay 5% or whatever that is. So what's happened in the UK has been a leveraging effect. And this has been in people's retirement accounts. This has been in endowment funds. This has been in, a variety of different funds, where pension funds, where people are relying on this. And the pension fund manager, they've done this in the UK and elsewhere, by the way. But this pension manager says, boy, these are safe, so let's leverage them. And that's always, isn't it always just somewhat of a recipe for disaster? And so the pension manager says, well, if we buy one of these bonds and spend $1,000, we can collect 5%. But if we did it on margin, if we basically bought more than what we actually have capital for, we just use someone else's money, hey, we can collect 5% times two. We can leverage it up. And the reason that this can make sense is, well, it's money good. The pension manager says unless the British government collapses and they default on their debt and so on, we think this is money good. In fact, in some circles they call it a risk-free rate of return, right? Because you assume the government's not going to implode. They can even print money to pay these off and so on. So if we can hold the bond all the way to maturity, we'll get the money paid back to us when it hits maturity, and we'll have collected 5% per year along the way. And so by leveraging it up, the pension manager says, hey, they're not going to go under. So, it's backed by the government. Oh, it'll be fine. Let's buy more of them than we actually have capital for. Now, that all sounds good on paper, right? They use history and they say, well, if we had been doing this for the past 50 years, then it would have got a better return, yada yada yada. And this is why it would work. And so if it would have worked in the last 50 years, why won't it work today? Here's the thing. When you're leveraging your brokerage, the financial institution now has some decision-making authority, right? Because you're using someone else's money, they now can make decisions on your account. So this pension manager has lost a little bit of his ability to do things, because if this gets in trouble, say that they have mark-to-market accounting, what if these bonds start to lose value? And why do they lose value? Because rates are skyrocketing. And so the value's dropping. These brokerages become nervous. These financial institutions say, hey, you need to add funds. You're getting a margin call. You need to add funds, or you need to liquidate some of your holdings to free up capital, even if it means you're taking a haircut. We need you to sell some of these bonds at $900 a piece. Yeah, they would mature worth 1,000, but you need to sell them, and they're only going for 900. And the reason you need to sell them is you need to free up some cash here, because we're not comfortable with the losses you're showing. And by the way, I mean, they can't just add money, because this is people's pension funds, right? You can't just call all these people and say, hey, add money to your retirement account. No, no, no. So they're getting margin called. They can't add funds, so they have to liquidate, and they have to liquidate them at a big loss. So a lot of these pension funds in the UK are taking a big hit. If they could hold these all the way to maturity, they'd get the $1,000 back. But because they're selling them early, forced liquidations, they're locking in big losses. So it's a mess. The UK, the Bank of England, says if we can stabilize the bond market so that it can work through this and not keep forcing people to liquidate, these bonds are good, assuming the government doesn't collapse. They're good assets if you can hold them all the way to maturity. The problem is, right, because you'll collect some income and you'll get the $1,000 back that you paid for them. They're good if you can hold them. If you're leveraged, you don't have that luxury. And it's like dominoes. As a margin call hits and pension funds have to sell, that pushes the market down more, pushes the value down more, and that triggers selling by other funds. And that triggers more selling and more selling. And you see how the markets can become unstable. This is what happens in an unstable market. Is it's like dominoes. If a big pension fund has to sell and it pushes the market price down, then that triggers other people to have to sell, and more selling and more selling. This is why I say selling begets more selling. These are not people that want to sell the assets. These are people that are forced to sell the assets. And that's a very different game. That's the way that when you start getting big losses in a market, it's forced liquidations that are the problem. It's not because, people say people are selling on fear. Well, true to a certain extent. There might be some fear-based selling, but what there is a lot of is forced selling, liquidations, right? This could happen to any individual that's using a lot of leverage and margin. It's now happening to pension managers. So, I mean, what a mess they've gotten themselves into. Now, you look at the UK market, how bad is it? A lot of these bonds have lost over 50% of their value. So instead of being if they were issued at 1,000, they're down to like $500 in value. I mean, it's a domino effect. And so this is not happening as much in the US as it is elsewhere, but in international markets, I mean, it's really the bond market that's creating the majority of the turmoil right now. And I just wanted to talk you through it so you can kind of see the moving parts. What's happening here? As rates have exploded and the bond prices have gone down, it's forcing liquidations because people are using leverage, even these big pension managers. They're now locking in losses because they're forced to sell to raise capital, to meet margin calls, and so on, and away we go. So the Bank of England has now said, hey, we stepped in, we bought some bonds, we tried to stem the downturn. Now we're getting back. So it's not a full 180. It's not, hey, we're back to a bond buying program. They're actually pulling that off and saying, we've just tried to step in to stabilize the markets, and now we're going to try to get out of it and let the markets operate. I don't know how this ends. A lot of people are betting that central banks are going to pivot, that they're going to change, that they're going to have to come back in with stimulus and so on. I don't know. You've got these two headwinds. You've got financial market stress, but you have inflation over here. And right now, central banks are battling inflation. It's creating some of the financial stress. Do they extend this out? Do they say, well, we've got to keep raising rates, but maybe we slow the pace of it? There can be not major pivots, not 180 changes, right? You're not going to flip 180 degrees where the US goes, oh, we're going to cut rates and we're going to buy billions in bonds. That's not happening tomorrow. Could it happen a year from now? Sure. It's not happening tomorrow. But could they slow the amount of rate hikes, the size of the rate hikes? Could they do like the Bank of England and step in temporarily and then step back out and so on? That's the world we live in. And so, I mean, central banks are more a part of the markets than ever before. Look, I traded 20 years ago and we used to talk about Greenspan and decisions that he was making and so on, but nothing like this. Every day it's all about the Fed, and it's kind of worrisome that they've become such an important piece because they're really bad at their job. if you if you look at their forecasts and then what actually happens and so on, they're not great at what they do. So that's a problem. PPI zero point 0.4 versus the zero point 0.2 expected. Inflation running a little hotter for producer price index. The market didn't react to that, but you see a similar result to that in the CPI. Um, if the CPI comes in zero point 0.2 more than expected, that's not going to give the markets a warm, fuzzy feeling. So PPI, they let the market get it, kind of got away with it. If CPI comes in much hotter than expected, oh, I don't know. I mean, you could see the markets down 4 or 5%, I suppose, in a single day if it was really ugly. If that inflation was way high, there could be a kind of panicky run for the exits. It'd probably be, a one-day event, and I don't know. I mean, maybe I'm making too much of it, but tomorrow's interesting because inflation is certainly a big part of it, and so much is riding on these central banks. GDP out of the UK came in at negative zero point 0.3 versus a flat expectation. So you're starting to see these economic hits. It's a bit of an issue. So as we look at the week, not surprisingly, as we've talked about, we're still in this bear market and everything's pretty much in the red. S&P, international markets, crypto down, gold, and oil having kind of a rough week. Oil has held up. I mean, it continues to hold up better than most, even though it's given back 5% this week. It actually was up, 10% last week. So it's kind of this thing where it's still hanging out in the 80s, the 90s per barrel, which is a pretty good number for energy companies. But on the weekly performance, again, everything just in the red. As you look at the S&P, this is why I say it's a little bit of a mixed bag. So we did get kind of this inverse cup and handle. If you wanted to call it a descending triangle, we always say that cup and handles and inverse cup and handles, they're kind of triangular patterns. That's kind of the mode, right? Lower highs but equal lows. So it's sort of a descending triangle, or if your eye sees it as a cup and handle, or in this case inverse cup and handle, great. As I said, it was a short-lived rally. I expected it to get up to about 38.50, right up in here. It didn't quite get there, just 38.10 or so. So kind of stopped a little bit shy of that, but now we're back down here and certainly vulnerable to further declines. Tomorrow, I think the reason the market's just kind of sideways is, well, it's the calm before the storm coming tomorrow. If there's one thing that's good for the market, it's you are starting to see these divergences. You're starting to see that price has been pressed to the downside. And as you've been falling, take the RSI as an example. You fell to lower lows and the RSI agreed. You fell to lower lows and the RSI agreed down here, right? So you're kind of, hey, this is sustainable. You should keep falling, and it kept going. Now the price is turning down, but the indicator's up at higher levels. So a little bit of a bullish divergence, a little bit of the indicator is saying we don't have the same downside momentum and pressure that we had before. That would change with a big drop. If you start to get this indicator will just drop down here and it'll kind of negate that. If you turn up, then this divergence looks really good and you could see, I mean, frankly, you could see a good sized rally here. I mean, at any point in time, the market stretched enough to the downside that you could get a 10-15% rally in the S&P and it would still be in a bear market, but it's just kind of it's stretched enough. There's been enough weakness, enough nervousness that you might be due for one of those big spikes, one of these rallies that really kind of shocks and surprises you. So I don't know. This one's tough. I'd almost play it to where you wait and see a little bit. You'd have to give the benefit of the doubt. Is in terms of a coin flip, we just have to give the benefit of the doubt to the downside, right? That's just where the trend and everything has been going. But a good sized rally does loom. I think it's not out of the question that we're going to get one in the not too distant future. The Aussie's having a rough week, the yen down a bit. This is kind of a mixed bag. I don't know, again, that I would make too much of this. The Kiwi up, but the Aussie down. Those don't really confirm. That's just kind of a weird thing. The dollar's up, but the yen's down. That's kind of a weird little dynamic. I think it's just kind of a weird week so far, so I wouldn't make too much of it. Crypto's a little more orderly in that they're just all selling off together, with the higher beta selling off in more aggressive fashion. Now, as we take a look here at some other factors, markets are in a downtrend and the slope has started to roll over and so forth. You're seeing that in other markets. Here's the international markets, which are still in a downward trend, 20 downward sloping, 50 rolling over. Trend is your friend, is the saying. Well, the trend is still down, so you'd have to err a little bit on that side of things. Bitcoin and crypto, little more downward pressure here. We could start to break out of this, but we're still not there yet. really crypto is just in this tight consolidation, and it sounds like a broken record, but it's just where we're at. I just don't know how you'd aggressively trade that. Once it starts to really trend, we might become interested again, but right now crypto's kind of boring from that standpoint. So let's take a look here. CPI anticipated to come in at 0.2. Now, that's not the end of the world. Remember, this is a month over month, and CPI is cumulative. So, meaning if you stack up, if you were to average 0.2 inflation over a 12-month period of time, well, 12 times 0.2 would only put you at an annualized inflation of 2.4%, which is right around the Fed target. And by the way, last month was 0.1. So the inflation numbers have already come down. The reason that inflation annually is still showing a high number is because, well, months back, we were reporting monthly numbers at 1.1%, 1.2%, and so forth. So as you stack a 0.1 and a 0.2, but then you start adding 1.1, 1.2, we still have this annualized inflation that's up here at too high of a number. And so here you're at on your year over year, we're still at 8.1. You've got to look at the good and the bad. The inflation's already coming down as seen by the monthly numbers. Now, here's why I say this could rock the markets. PPI came in at 0.4. If this comes in at 0.4, I just think the markets overreact to that. I really would expect, and markets will trick you sometimes, but man, if it comes in at 0.4, I could envision the markets being down 3% just in the futures overnight. I mean, it could be pretty rough. If you came in at 0, if you had a surprisingly low inflation, well, heck, now you could argue the markets might be up 2-3%. If it comes in at 0.2, so 0.1, 0.3, it's probably not as big of a deal because the markets are kind of expecting that. But anything that's outside of the expectations could be pretty rough or could be really good. I don't expect that necessarily. I don't have some opinion that, hey, it's going to come in this way or that way. The weird thing is, in my mind, here's what I think is actually happening. I actually think inflation is coming down pretty well, but the problem is that in this calculation are things that historically are not very inflationary. Things that move more slowly, things that don't change, but those are the things that have kind of spiked up. If you take something like rent, there's really weird numbers in the CPI, but there's something that they call owner equivalent rent. They take these calculations of, well, if you were to rent this out, then how much could you get, and so on. And we had this weird dynamic where housing prices were going up for a period and rents were going up, and that's not historically something that skyrockets. It moves very slow. Years ago, they started adding this more to the inflation and taking out, things like food and energy, because the government's not dumb. They say, well, let's take out the things that typically are inflationary and put in things that aren't. The problem is that now the things that aren't inflationary are slower to move. So are people cutting rent aggressively? No, not right now. Like, I own some property. I'm not, if anything, I'm raising rent. I'm not cutting it, right? We're still in that market environment. And if rent is 30% of the CPI, well, it's just not going to come down aggressively right here, right now. So it's kind of this weird thing where I'm worried that the CPI number is going to come out a little hot, even though I don't necessarily think that this is measuring things correctly. I think that it's measuring things that don't come down just the same way that they didn't usually go up a lot. They don't come down super fast either. They don't move a ton. Rents have probably kind of flattened out a little bit more. But if anything, they're still kind of in this rise, even though there's some economic downturns and so on. And I don't think the Fed raising rates is going to cause rents to go down immediately in the short term. It's just a slower market. It's just something that takes time for rent to start to turn and so on. So, anyway, it's probably my fear for the markets is that this number comes in hot, even though I think the things that the consumers are most worried about have already started to back off. So it's this weird kind of dynamic that way. There's also things that are good inflation. You know, when you think about people getting more wages paid to them, getting, wage inflation, man, that's a good thing. Again, they like having that in the CPI because businesses don't want to raise people's payouts very often, right? So businesses try to really not pay more to their employees. That's kind of the history of it. And there's of course good businesses that are willing to pay more and take care of there's always exceptions, but as a whole, a lot of businesses will say, well, as soon as somebody wants more, we'll just find a replacement for them and that sort of thing, especially in things like fast food, this and that. Well, it's been a weird market where wages have gone up. I say that's a good thing. They, I mean, the Fed's reacting because inflation's going up. And again, wages, they're hard to get back down once they've gone up. I mean, do you start going in and cutting people's pay immediately? Probably not. It's hard to get those back going the other way. That's why they like to have that in here, is because wages didn't go up at a sharp pace, weren't very inflationary, and now they're kind of paying the price for how they calculate inflation, which I kind of find funny. So let's take a look at a few different things. Stephen points out the British pound, they did, no question, what they did to kind of step in actually had a real effect on the pound. No doubt about it. So let's pull up the pound as kind of a starting point here. And if we come over, here's pound USD. If you look back to where basically the Bank of England stepped in, this is a daily chart. And the initial knee-jerk reaction was for the pound to sell off on that news, right? That they were coming in with a bond buying program. It kind of plummeted and then recovered. Well, we're up since then. The pound is higher overall. Let's look at it versus a few different things. Here it is against the Canadian dollar, up a lot. Here it is against the Australian dollar, up a ton. So the pound is certainly rebounded, rallied aggressively since that announcement. And so isn't it funny that the market's knee-jerk reaction is actually the opposite of what it's done, since then? The market kind of went, oh, this is bad for the pound. Oh, whoops, pound, kind of flushed out. And that's kind of anyone that was willing to sell. The pound has been bad for so long. I mean, you just look at this downward trend. It's been bad, 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 bad. And so when that finally came out, I think this makes perfect sense if you think through the psychology of the markets, in that we had been down, 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 and then this quote unquote bad news, which it should be bad for the pound from the standpoint of them printing money, buying bond. That's a stimulative program that tends to be bad for your currency, right? Instead, that was kind of the final flush. That was the exclamation point. And it comes full circle. The pound is going down, and then when you finally get all of that should be priced in and be negative for the pound, it's kind of the old buy the rumor, sell the news. That's the final piece. Anyone that's willing to sell the pound sold it in a panic. It flushed out those final sellers, and now the path of least resistance is the other way. Because if this has washed out all the people that are willing to sell the pound, who's left? If no one else is left that's really willing to sell, there's only one direction it can go, and that's back up. So you have a little bit of a seller strike where it flushed them out. That's kind of an interesting dynamic. The US dollar, what I think is in play is not a great trading scenario for the US dollar, because I think we're going to kind of do this. This is where I think we're at for a little bit longer. It could change my mind tomorrow, and what would do that is probably a big break here, which would probably happen. Again, this chart is euro going down, US dollar going up. So the way that it would have a big break like this would be the US dollar spiking. And the US dollar probably spikes if the CPI comes in hotter than expected. If it comes in high, then they're going to say the Fed is going to stay hawkish. It's going to raise more rates. It's going to do that. And the knee-jerk reaction would be for the US dollar to rally. So tomorrow's CPI makes or breaks this chart pattern, but I think we're in kind of this symmetrical triangle. I just don't know if tomorrow's going to be the breaking point for that possible pattern. Yeah, trading ideas right now are a little scarce for me in FX. I just don't know that I have something where I can kind of pound the table and say, let's focus on that. Look at this. This is great. You know, you've got Aussie going one way and Kiwi going the other. You got yen going this way and US dollar going the other, and so on. The yen is kind of interesting in that, I mean, if you look at all these charts, they're all for the most part bullish versus the yen, right? Uptrends and sideways trends against the yen. It's for the most part, I mean, I guess you could say the Aussie's about the only thing and the Kiwi's about the only thing that are weaker than the yen over the past month or so. You know, do we bet on that continuing? Do we bet on the Aussie recovering here? I'd say this kind of speaks to, if you're looking at the weakest areas, Aussie and Kiwi and some of those have been pretty darn weak. Yen is in that next level of weakness. Obviously, the stronger things, I mean, US dollar's obvious. And lately, even, I'll kind of put the pound just below it, but it's like next level compared to the US dollar in strength. It's seeing some recent buying pressure. My thought would be I would actually probably still go short Aussie yen here, Kiwi yen, those sorts of trades if it were up to me. I'm a little nervous. I've talked about this most of this year. I don't know what Japan's gonna do, but they make me nervous in terms of possibilities. I would rather be long the yen than short it from the standpoint of Bank of Japan risk and what they might do. Now, that might be wrong, but that's kind of how I see it. I just see it as there's so many people short the yen that it would make me nervous to be shorted as well. So I kind of still like, if you have to do something in terms of the yen, maybe you look to short Aussie yen for more downside, Kiwi yen, something like that. That'll get you long the yen, which isn't something that I necessarily want to be, but to answer your question, I guess that's where I would lean in trading it. But it's kind of tough right now. Bitcoin, crypto, I don't know that there's a lot there either. It's weird because tomorrow you've got the CPI and you know that there could be this big bursting move, and I just don't know how best to take advantage of it. Usually I have some idea. I go, you know, we're trading the RBA and here's the currency we're going to focus on. I mean, if anyone that's been with us, I almost always have some idea for trading a big event. Hey, these are the pairs that I'm watching. I don't know, man. I don't know where I'd lean. It does, I'll say this, it makes me very nervous. The CPI number is going to come in hot, like we already talked about, that it could hit a 0.3, 0.4, that you could see a market meltdown, and you could see the US dollar with a huge spike higher. So if you put a gun to my head and I have to take a trade, I suppose I'm going to be long the US dollar, uh, you know, just Not even that I necessarily think that that's likely. It's just that there could be a lot of reward in the short term. So if you were short something like Euro USD, it would be dangerous, but it would have a big potential payoff if that CPI comes in hot. And I wouldn't overstay my welcome. I'd probably take profits on it, relatively quickly. But I do worry that the stock market's going to have a bad day, that the US dollar is going to spike aggressively higher tomorrow. Um, Not that it's high probability, but that it could be a pretty big move. And not great for risk assets, not great for markets because the dominoes are what I'm worried about. Remember, if you get that high CPI, that also means that interest rates are probably going up, that bonds are taking another leg down, that's going to force more liquidations. I mean, that's where the markets are vulnerable. And in some ways, the markets go after vulnerabilities, and they go after vulnerabilities to kind of exploit them. We call it max pain, right? When the market, it's almost like a shark is the market. When it smells blood, it goes for the kill. And right now, the bond market is bleeding, and it might try to kill the market. And that's where, central banks and so on step in. And whenever you're getting interventions from central banks, that's not a good thing. That doesn't produce a warm, fuzzy feeling. You know that they're doing that out of chaos and confusion and pain in certain markets and so on. And uh, I am nervous for the markets that there's going to be a little bad news with that inflation print that could fuel that next domino. So hope I'm wrong about that, but doesn't give me a warm fuzzy feeling going into that announcement tomorrow. And hope it's a dud. Hope that CPI comes in, the market just kind of goes, okay, no big deal, and we move on. Uh, I, Maybe wishful thinking, but there we go. All right, let's take a look at the rest of this week. So we have a preview coming out for the CPI. I'll be listening in on that one. That recording is coming out. May have already come out. I'm not sure, but I'm curious to hear what some of our other traders here at Maverick are thinking for that CPI and maybe pairs that they're watching. There will be a currency recap recording on Thursday. And then, as always, we'll wrap things up with our weekend trading room. Thanks, everyone, for being here. It's a lot of fun to be with you each week in these midweek roundups. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.